Okay, so you want to own a data center. You picture it in your head, and honestly, it's a beautiful picture. A long, low building on the edge of town. No windows. No sign out front. Just a quiet gray box humming behind a fence, cameras on every corner, a single door with a badge reader. Inside, it's cold, deliberately cold, and dark except for the little green and blue lights blinking in endless rows. Rack after rack after rack of servers, stacked floor to ceiling, all of them owned by companies that pay you every single month just to keep their machines alive and online. You don't sell a product. You don't chase customers. You just own the room. The room the internet lives in. Netflix streams through it. Your bank runs on it. Someone's entire startup is sitting on a shelf you control. And every 30 days, the money lands in your account whether it's raining or sunny, whether the economy is booming or falling apart, because the world cannot turn the internet off. That's the picture. That's the brochure. That's what every glossy investor deck and every digital infrastructure is the new real estate headline is selling you. Here's the problem. Nobody shows you the power bill. Nobody shows you the backup generators the size of shipping containers that you have to test every month and may never use. Nobody shows you the moment the local utility tells you there's no more electricity to give you, that the grid is full, and your half-finished building becomes a very expensive concrete shell. Nobody shows you the cooling systems that cost more than the servers, the insurance premiums, the diesel, the water, the property taxes on land you overpaid for, and the brutal, unforgiving math of a business where a few seconds of downtime can end a client relationship forever. So let me reframe the whole thing for you right now, and I want you to sit with this one. A data center is not really a technology business. It's not really a real estate business either, even though everyone calls it that. A data center is a power business that happens to have buildings attached to it. You are not selling square footage. You are selling electricity, cooling, and the promise that both will never, ever stop. Read that again. By the end of this, you'll understand exactly where the money comes in, where it quietly bleeds out, why the single most valuable thing in this entire industry isn't the server or the building but the wire between them, and why a company can be worth $3.5 billion one year and be in bankruptcy court the next. You'll understand why the smartest money in the world is pouring into these gray boxes right now, and why most people who try to copy them lose everything. Let's build it from the ground up. Now, before we talk about money, we need to talk about what a data center actually is. Because data center is one of those words that hides four completely different businesses wearing the same coat. Some data centers are what the industry calls hyperscale. These are the giants, the buildings Amazon, Microsoft, Google, and Meta build for themselves, campuses that can draw hundreds of megawatts of power, that cost well over $1 billion, that exist to run one company's own cloud. If you're watching this, you are not building one of these. You cannot. The entry fee is a Fortune 100 balance sheet. Some data centers are enterprise data centers the private server room a hospital or a bank builds for its own use, in its own basement, for its own data. That's not really a business. That's a cost center. And some data centers are the ones we actually care about, colocation facilities. Colocation, or colo for short, is a simple idea. You build the building, you supply the power, the cooling, the security, and the internet connections. Then you rent space inside it to other companies who bring their own servers and pay you to house them. You're a landlord, but instead of renting apartments to people, you're renting climate-controlled, power-drenched, ultra-secure shelves to machines. Within colocation, there's another split. There's retail colocation, where you rent out small amounts of space, a single rack, or even part of a rack, to lots of different customers. And there's wholesale colocation, where you lease enormous chunks of a building, sometimes an entire data hall, to one big customer on a long contract. Retail is like renting individual hotel rooms. Wholesale is like leasing an entire floor to one corporation for 10 years. For the rest of this, we're focusing on colocation, because that's the version a serious private operator can actually build and own. And I want you to hold on to that landlord metaphor, because in a few minutes I'm going to take it apart and show you why it's wrong. Okay, so, the biggest upfront cost. The number that makes people flinch. In this business, you don't measure a data center by square feet. You measure it by megawatts. A megawatt, or MW, is a unit of power, roughly enough electricity to run somewhere between 200 and 1,000 average homes, depending on the day. In a data center, power is everything, so power is the ruler you build with. And here's the number the industry uses. It costs somewhere between $7 million and $12 million to build 1 megawatt of data center capacity. Some estimates run higher now, north of 13 or 14 million a megawatt for the most advanced, high-density AI-ready facilities, according to figures cited by real estate and construction firms like JLL and Cushman & Wakefield, who track this market closely. Let that land for a moment. Not $7 million for the whole building, $7 to $12 million per megawatt. A modest co-location facility might be 10, 20, 30 megawatts. So even a small, serious data center is a $200 million to $400 million construction project before you have earned a single dollar of rent. And here's the lesson buried in that number, the one that separates people who make money from people who go bankrupt. The price to build is not the same as the ability to profit. Those are two completely different numbers. You can build the most beautiful, most redundant, most expensive data center in the region and still lose money every month, because what determines your profit is not what you spent. It's whether you can fill it, power it, and cool it cheaper than the rent you collect. The expensive building is just the ticket to enter the game. It doesn't tell you whether you'll win it. So far, so good. You've got your land, you've got your building, you've got your megawatts. Now here's the part nobody puts in the brochure. The costs nobody budgets for. Let me walk you through them in order, because the order matters. First, redundancy. In a normal building, if the power flickers, you light a candle and wait. In a data center, if the power flickers for even a fraction of a second, servers crash, data is lost, and clients leave. So you cannot have one power path. You need backups for your backups. This is measured by something called the tier system, defined by a real organization called the Uptime Institute. Tier 1 is a basic setup. Tier 4 is fault-tolerant. It's designed so that any single piece of equipment can fail, and the whole thing keeps running without a hiccup. A Tier 4 facility targets around 99.995% uptime, which works out to less than half an hour of allowable downtime per year. To get there, you're buying everything twice. 2 power feeds. 2 sets of cooling. 2 of everything. That redundancy can add tens of % to your entire build cost. You are literally paying millions of dollars for equipment you hope to never use. Second, the backup power itself. When the grid does go down, and it will, you can't just wait. So you install banks of batteries called a UPS, an uninterruptible power supply, which carry the load for the few seconds it takes for the next layer to kick in. And that next layer is diesel generators. Big ones. Industrial generators the size of shipping containers, often several of them, that can cost hundreds of thousands to over $1 million each installed. And here's the wry part. You have to buy thousands of gallons of diesel fuel to sit in tanks, and you have to burn some of it every single month just to test the generators and prove to your clients they work. You are paying to run engines that produce nothing, just to prove you could. Third, cooling. This is the one that shocks people. All those servers turn electricity into heat, nearly all of it, and if you don't remove that heat fast enough, the machines cook themselves and shut down within minutes. So you build a second, hidden power plant whose only job is to move heat out of the building. Chillers, computer room air conditioners, cooling towers, sometimes millions of gallons of water. And here's the brutal math. For a long time, the industry standard was that for every dollar of electricity you spent running the servers, you spent roughly another 50 cents just running the cooling and the overhead. The industry even has a number for this. It's called PUE, Power Usage Effectiveness. A PUE of 1.0 would mean every watt goes to the servers and nothing is wasted. According to the Uptime Institute's global surveys, the real-world average has hovered around 1.5 to 1.6 for years, meaning something like a third to a half of your total power is spent just keeping the room cold and running. The best hyperscalers, like Google, have pushed theirs down near 1.1, but they spent a fortune in engineering to get there. Fourth, connectivity and security. A data center that isn't connected to the internet is just an expensive freezer full of computers. You need multiple fiber optic lines entering the building from different directions, so that if one gets cut by a backhoe, and this happens, you don't go dark. You need physical security that would embarrass a bank, fencing, man-traps, biometric scanners, 24-hour guards, cameras logging every face. And you need staff, certifications, and audits, because your client's own auditors will demand proof that their data is physically safe. Add all that up, the redundant power, the generators, the cooling plant, the fiber, the security, and you start to see it. Most of the cost of a data center has nothing to do with computers. You are building a fortress wrapped around a power station wrapped around an air conditioner. The servers are almost an afterthought. And they're not even yours. Now, here's where it gets interesting. Here's the core reveal, the thing that recontextualizes this entire business. Slow down for this one. You would think that in a data center, the constraint, the thing you run out of first, is space. Floor space. Room for more racks. That's what real estate implies, right? Wrong. The thing you run out of first is power. Modern servers, especially the ones running artificial intelligence, are getting denser and hungrier every year. A single rack, one of those refrigerator-sized cabinets, used to draw maybe 5 to 10 kilowatts of power. Today, AI racks packed with high-end chips can draw 40, 60, even 100 kilowatts or more. That means a room that could physically hold 100 racks might only have enough power and cooling to run 20 of them. You'll have empty floor space and no ability to use it, because the electricity is gone. So the real product you sell is not square footage. It is not room. It is kilowatts, delivered reliably and cooled adequately. You are, functionally, a specialized utility company. The building is just the packaging. And this is why the single most valuable data centers on Earth are not the ones with the most land. They're the ones in the few places with cheap, abundant, reliable electricity and fat internet connections. There's a stretch of Northern Virginia, Loudoun County, a place the industry literally calls Data Center Alley, that routes an enormous share of the world's internet traffic. For years its vacancy rate has been near record lows, at times reported by real estate firm CBRE as under 3%, sometimes barely above 1%. Not because they ran out of land. Virginia has plenty of land. Because the local utility, Dominion Energy, has at points warned that it simply cannot deliver electricity fast enough to power all the data centers people want to build. Read that again. The bottleneck isn't dirt. It's not concrete. It's the wire coming out of the wall. That's not a real estate business. That's an electricity business. Okay, now let's talk about how the money actually comes in, because it arrives in distinct layers, and the layers matter enormously. The first layer is space and power rent. This is the base. You charge your colocation clients a recurring monthly fee, usually priced per kilowatt of power they've reserved. Industry figures put retail colocation pricing somewhere in the range of roughly $100 to $200 per kilowatt per month, varying wildly by market and by how much power density the client needs. A client renting a single rack drawing 5 kilowatts might pay somewhere in the neighborhood of $500 to $1,000 a month for that rack. Multiply that across a full building and you get your foundation. It's steady. It's contracted. It's boring. And boring is exactly what you want. The second layer is the power markup. Here's a quiet little engine of profit. In many colocation contracts, you don't just charge for the space. You pass through the electricity your client uses, sometimes with a metering and management margin on top. You buy power wholesale, at utility rates, and you deliver it to the client conditioned, cooled, and guaranteed never to fail. The client is not just paying for electrons. They're paying for reliable electrons. And reliability has a price. The third layer, and this is the beautiful one, is interconnection. Cross-connects. Now, here's the thing. When you have hundreds of company servers all sitting in the same building, those companies often want to connect directly to each other. A streaming company wants to plug straight into an internet provider. A trading firm wants a direct line to an exchange. Instead of sending that data out onto the public internet and back, you simply run a physical cable, a cross-connect, from one client's rack to another client's rack inside your building. That cable might be 20 feet long, and you charge for it every single month. Often somewhere between $100 and $300 a month per cable for a piece of fiber that costs you almost nothing and takes a technician 10 minutes to plug in. Let that sink in. The company Equinix, the largest colocation operator in the world, has built its entire empire on this. Equinix has reported having well over 400,000 of these cross-connects across its facilities. Do the math on a couple $100 a month times 400,000 cables, and you begin to understand why Equinix is worth tens of billions of dollars. The cross-connect is nearly pure profit. It is the highest margin product in the building. The rent pays the bills. The wire is where the real money hides. That's the through line of this whole business, by the way. The obvious product, floor space, is the low-margin commodity. The invisible products, power and connection, are where the profit actually lives. Now, the money doesn't just flow in. It bleeds out too, every single day, whether you have clients or not. So let's talk about operating costs, the recurring monthly wound. The single biggest one, by far, is electricity. A data center is one of the most power-hungry buildings a private company can own. According to a 2024 report from Lawrence Berkeley National Laboratory, a U.S. Department of Energy lab, data centers consumed something like 4.4% of all electricity in the United States in 2023, and they projected that could climb to somewhere between 6.7% and 12% of the entire nation's electricity by 2028, driven by AI. For a single facility, the power bill can run into the millions of dollars a month. And remember PUE, you're not just paying for the power your clients use. You're paying the cooling tax on top of every watt. Then there's labor. You need skilled electricians, mechanical engineers, network technicians, and security staff, around the clock, 3 shifts a day, every day of the year, because the building never sleeps. Then repairs and maintenance, testing generators, servicing chillers, swapping failing batteries in the UPS. Then property taxes, often on a very expensive facility in a competitive market. Then insurance, and it's not cheap, because you're insuring against fire, flood, equipment failure, and the catastrophic liability of losing a client's data. Here's the uncomfortable part. Most of these costs are fixed. The building costs nearly the same to run whether it's 90% full or 40% full. The generators still need testing. The cooling still runs. The guards still guard. Which means your profit lives entirely in that gap between how full you are and how much it costs to keep the lights on. A half-empty data center isn't half as profitable. It can lose money outright. And that leads us straight into risk. Because this business has a specific, structural way of breaking, and it's worth understanding the mechanism. The threat isn't really that the internet goes away. It won't. The threat is that you make a massive, long-term, irreversible bet, hundreds of millions of dollars poured into concrete and copper, based on assumptions about the future, and those assumptions shift underneath you. Here's the trap. You borrow enormous amounts of money to build. Data centers are almost always heavily financed with debt, because the upfront cost is so brutal. That debt was cheap when interest rates were near zero. But interest rates don't stay near zero. When they rise, the cost of carrying that debt explodes, and a facility that penciled out beautifully at 2% interest becomes a millstone at 7%. And here's the second half of the trap. Technology moves. The kind of data center that made perfect sense in 2010, lots of small cages for companies running their own servers, started to become obsolete as those same companies moved their computing to the cloud, to Amazon and Microsoft. Suddenly the thing you built, the thing you borrowed a fortune to build, is the thing fewer people want. You're locked into a 20-year building serving a market that moved on in 5. Debt that gets more expensive. Technology that changes what customers want. Put those two together and you don't have a slow decline. You have a cliff. Which brings us to the case study. Let me tell you a real one. There was a company called Sixtra Technologies. And its story is the whole thesis of this video, compressed into about 6 years. Sixtra was born in 2017, when an investment group led by a real businessman named Manuel Medina acquired a huge portfolio of data centers, dozens of facilities around the world, that had previously belonged to the telecom giant CenturyLink. Overnight, Sixtra became one of the largest retail colocation operators on the planet. More than 50 data centers. A global footprint. Blue-chip customers. On paper, it had everything. It owned the rooms the internet lived in. The rise looked spectacular. In 2021, at the height of the market, Cheap money everywhere, everyone hungry for digital infrastructure. Sixtra went public by merging with a special purpose acquisition company, a SPAC. The deal valued the company at around $3.5 billion. $3.5 billion. Executives rang the bell. The story was perfect. The picket and shovel provider of the digital age, a landlord to the internet, riding an unstoppable wave. Now, here's where it gets interesting. Look under the hood of that beautiful story, and you find the trap I just described, both halves of it. First, the debt. Sixtra had been built with an enormous pile of borrowed money, well over $2 billion of it. As long as interest rates stayed low, the company could carry that load. But starting in 2022, the Federal Reserve raised interest rates faster than it had in decades. The cost of that debt climbed and climbed. Second, the technology shift. Sixtra's business was mostly retail colocation, renting smaller cages to enterprises. But the world was racing toward the big public clouds and toward giant wholesale and AI-focused facilities. Sixtra was, in a sense, a champion of the previous era, carrying yesterday's debt into tomorrow's market. The decline was fast. By early 2023, the company was openly warning investors it might not survive. And in June of 2023, less than 2 years after that $3.5 billion debut, Sixtra Technologies filed for Chapter 11 bankruptcy, buried under roughly $2.5 billion of debt. Its assets were ultimately picked up by others. Much of the value ended up in the hands of Brookfield, one of the largest infrastructure investors in the world, who folded it into their operations. So what's the lesson? Sixtra didn't fail because the internet stopped growing. Demand for data centers was booming the entire time it went bankrupt. Read that again. It went broke in the middle of the biggest data center boom in history. It failed because it was a heavily indebted bet on the wrong version of the business, and when the cost of that debt rose, there was no room left to breathe. The building was full of humming servers the whole way down. The machines never stopped blinking. The money just ran out. That's the difference between owning the internet's real estate and actually making money from it. Okay, so if it's this dangerous, why is the smartest, richest money on earth pouring into data centers right now? Because there's a deeper game here, and the people who win it are not thinking about it as a landlord at all. Here's the first part of the deeper game. Contracts and stickiness. Once a client's servers are physically installed in your building, wired into your cross-connects, integrated into their operations, they are extraordinarily hard to move. Physically relocating live servers is expensive, risky, and terrifying to any IT team. So your clients tend to stay for years, and they tend to renew, and they tend to grow inside your building rather than leave it. In the trade, they call this being sticky. You're not just collecting rent. You're collecting rent from a tenant who has quietly chained their furniture to your floor. Here's the second part. The land and the power rights themselves are appreciating assets. Remember Data Center Alley? Remember the utility that can't deliver power fast enough? If you own a site that already has a large, secured, guaranteed supply of electricity connected to it, you own something that is becoming rarer and more valuable by the month. In an AI-hungry world, a piece of land with 200 megawatts of grid connection is almost a form of treasure. You're not just renting racks. You're sitting on a scarce resource, power access, that the whole economy is now competing for. And here's the third part, the sophisticated money part. To the giant infrastructure investors, the Brookfields, the Blackstones, the big pension and sovereign wealth funds, a well-leased data center is not a tech gamble at all. It's a bond substitute. It's a boring, contracted, inflation-linked stream of cash flows secured by a physical asset, exactly the kind of thing a pension fund needs to pay retirees for the next 30 years. They can borrow cheaply against it, hold it for decades, let the land appreciate, and collect the rent. They're not playing the same game as the founder who's sweating the monthly power bill. They're using the data center as a machine for converting patient money into steady, secured yield. That's the reframe. The person who thinks they're buying a high-tech business often loses. The person who understands they're buying a leveraged power and yield asset, and who doesn't drown in debt, quietly wins. So let's put real numbers on it. 2 scenarios. Same building, different year. The good year. Your facility is 90% full. Your contracts are locked in on multi-year terms. Interest rates are stable, so your debt payments are predictable. Your cross-connects are multiplying. Every new client adds a handful of those little high-margin cables. Power prices are steady, and you're passing your electricity costs through to clients with a healthy margin on top. Your building is humming near capacity, your fixed costs are spread across a full house, and every incremental client is almost pure profit because the guards and the generators and the chillers are already paid for. In a year like this, a well-run facility can throw off strong, dependable cash flow, the kind that makes infrastructure investors line up at the door, the kind that gets valued as a multiple of that steady income and makes the whole asset worth more than you paid to build it. Life is good. The green lights blink. The money lands every 30 days, exactly like the brochure promised. Now the bad year. A major client, one that took a whole data haul on a wholesale deal, doesn't renew. Suddenly you're at 60% occupancy, but your costs barely move, because the building runs almost the same whether it's full or not. At the same time, interest rates have jumped, and that mountain of construction debt you took on now costs millions more a year to service. A heat wave spikes your cooling costs and your power bills in the same quarter. And the new clients you were counting on. They went to a competitor down the road who built a newer, denser, AI-ready facility, because your building was designed for the last era. Your revenue is down, your debt payment is up, your fixed costs won't budge, and that gap, the beautiful profit gap from the good year, has inverted. Now you're bleeding, and if that gap stays negative long enough, you become the next name on the bankruptcy docket, sitting in a full building of blinking machines, watching the money run out. Just like Sixtera. Same box. Same servers. Same humming green lights. The difference between the good year and the bad year was never the technology. It was occupancy, debt, and power. It was always power. So let's go back to the beginning. Back to that quiet gray box on the edge of town, windowless and cold, humming behind its fence. The room where the internet lives. You thought you were buying that room. You thought you were buying the servers, the racks, the futuristic glow of owning a piece of the digital age. But you weren't. The servers aren't yours. They belong to your clients. The glow is just heat you're paying a fortune to remove. The room is just concrete. What you were really buying was the electricity coming out of the wall, and the wire running between two racks, and the contract that keeps a client chained to your floor for the next 10 years. What you were really buying was a power company wearing the costume of a building. The blinking lights aren't the business. The wire is.